Hey traders, welcome back to Trade Empire. Today in this video, we will start by explaining the concepts of fair value gap and order blocks in details. Next, we will cover the rules we use to identify valid order blocks and fair value gaps. Then we will teach you the trading strategy based on order blocks and fair value gaps. Next, we will talk about the psychology behind it. And we will also show you multiple chart examples, so you can learn everything practically. See you after a short intro. Back to the video. Here we have a bearish market structure, a significant imbalance between buyers and sellers. In the most recent impulse, caused this rapid downward push. And this supply-demand imbalance can be identified by the formation of fair value gap. It is a void between the shadow of 3 consecutive candles. Now the price is sell-side inefficient, making it more likely to return it to the gap area and fill the gap. Fair value gaps can come in different sizes and numbers. Each gap needs a different approach as we try to enter the market with a specific strategy. In the first example, we have multiple fair value gaps within a single impulsive move, but the question here is, which fair value gap should we use to trade? We should wait for price to enter these zones and look for buying opportunities. However, we will only be interested in these 2 areas. Because if we consider the start and end of this impulsive move, and we apply the retracement tool, we can see that the bottom fair value gaps are in the discount zone. That's why we prefer these zones to look for buying opportunities. The main reason for considering these bottom fair value gaps as important, because market loves to take out the early buyers. So that's why we wait for the price to enter the discount zone before entering the trade. It increases the chance of success and decrease the risk of being caught in liquidity grab. In the next example, we have a small fair value gap near a swing low. And in this situation, we will set our buy order at this fair value gap and set our stop loss just below this swing low. And the first target will be this latest high. This creates an ideal trading setup, as our stop loss is safely placed below the swing low. And our target is the recent high, which has a high chance of being hit. In the last example, we have a big fair value gap zone, and we cannot enter at the start of this gap. If we do this, our stop loss will be much bigger, and target will be small, and there's a high chance of being stopped out. But if we enter in the middle of this gap zone, our risk and reward ratio is still not favorable. So what we do here is to wait for the price to tap into our fair value gap area, and we will then move into the lower time frame. After moving into the lower time frame, we will see a correction as a short-term downtrend, and in this situation, we will wait for the price to make a change of character, and after that we will enter the market. Now we have a great reward and low-risk trade, and that's what we were looking for. Now let's discuss the order blocks. So the first question is, how to identify high-probability order blocks? After the formation of fair value gap, we mark the last candle of that impulse move as our order block, as we believe that the decisions by the big players were made during this candle. And like the fair value gaps, when price come back to these order block areas, there's a high chance for the price to reverse and give us a great opportunity to go long. The candles that we mark as order blocks can come in different sizes and shapes on the chart. When we have small order blocks, we consider adding more space to this order block area. Or consider setting a large stop loss if we set a buy limit order here. The reason for doing this is that the order blocks are considered as powerful trading areas. But rejecting exactly from this area is not necessary for the price. So that's why we have to be realistic when setting stops and entries. But if we have large order blocks, we should wait for the price to tap into it. And then we will move into the lower time frame to find confirmation. And there we will enter at a better price with a reasonable risk and reward ratio. Let me show you some of the rules to identify fair value gaps and order blocks. First rule is, aligning with the market direction. As we know that identifying the market direction is the first and main step in analyzing a price chart, and we always aim to trade aligned with the controlling side of the market. Next rule is collecting the liquidity. When we analyze a price chart, we treat support and resistance level as liquidity areas. Mainly equal highs and equal lows or multiple rejections, which we consider as key liquidity zones. We all know that liquidity is a key factor influencing price movements. Here's an important point. The market generally moves toward levels with available liquidity and tends to move away from areas where liquidity has recently been grabbed. Collecting liquidity before reaching an order block or fair value gap serves as further confirmation for the price to make the moves we want to see in the market. The third rule is break of structure. A break of structure forms when the price breaks through a level that previously rejected the price. So, what does this represent in terms of price action? It indicates that the impulse move that created this breakout was not a temporary reaction, it was a sign of heavy momentum in the market. So a demand area that caused this break of structure becomes a stronger signal. And by combining break of structure with order blocks and fair value gaps, we can identify the points where momentum is confirmed and enter trade with full confirmation. Order block or fair value gap, which one is our preferred choice? The answer to this question is very simple. It's important to know that these both entry types can be profitable. But the choice depends on the asset you are trading and your entry time frame. Sometimes order blocks can be more accurate for some pairs, while sometimes fair value gaps works better for other pairs. So before you place any trade, you should backtest each method on your selected asset. By doing this, you will be able to know that which method is suitable for which pair. But if I told you our best choice, we prefer order blocks rather than fair value gaps. Now let me show you a real chart example, so you can easily understood what I am saying. Here on the euro-dollar for our chart, this latest impulse move has done this break of structure, indicating a strong bearish momentum. This latest move has created two fair value gaps. And we also mark the first candle of this wave as our order block. Now all of these three marked zones can act as a supply zone and give us an opportunity to go short. And now our plan is to wait for a pullback, and then we will look for entry at a better price. The important point here is that, regardless of our entry point, our stop loss must be set above this order block candle to avoid being affected by the market fluctuations. And our first take profit target will be the close of this candle. But here's a question, where will be our entry? If we apply the retracement tool on this latest move, we will see that only this fair value gap and order block is in premium zone, while this fair value gap is in discount zone. And we know that we always try to sell in premium and buy in discount. So now we will remove this fair value gap, because we are not interested in this. Now what happens if we set a sell limit order at this fair value gap? By doing this, we have a higher chance that price will trigger our trade. But the main problem here is that our stop loss will be too large. Even if we set our limit order in the middle of this fair value gap, our stop loss still be too large. And if we try to set our stop loss above this fair value gap zone, it will be in the order block or supply zone. And there's a high chance that our stop loss will be triggered before our first take profit. Even if you decide to move into the lower time frame to find confirmation in the fair value gap zone, the things will still be against you, because higher time frame supply or demand areas are in priority. And the best way to enter the market in situations like this is to set our sell order at the start of this order block zone. By doing this, the chances of getting our order trigger decreases, but our trading accuracy increases, and if order triggers, we will get a great reward with very low risk. If the order block is too large, then we will set our limit order in the middle of order block zone. Here's an important point. Waiting for high-quality trades and filtering our low-quality one is a vital skill that every trader must develop. Now let me show you a list of pros and cons of entering at order blocks and fair value gaps. Trading on order blocks have higher risk to reward ratio, strong reaction areas, safer stop-loss placements, and conservative trading approach. But the one con of order block is that we will miss many opportunities. In fair value gaps, we have early entries, dynamic price reactions, and frequent occurrence. And two main cons in fair value gaps are larger stop losses and higher risk of liquidity grabs. So guys, that's all for today. If this video has provided you some knowledge, please leave a like and subscribe the channel for more trading videos. Wish you good luck for your trading journey.